So psychology, I think, is highly overrated. Psychology comes with skill, right? The more skill you have, the less you have to worry about psychology.
Yeah.
I get a lot of DMs saying, hey, I'm good in trading in general, but I'm lacking psychology and that's why I'm not making money. No, you're lacking in skill. They do finger pointing and the finger pointing is their psychology. Whereas the problem is not the psychology, it's the skill, right? So that's why I would always say psychology is overrated. And then I just focus on two factors. It's my fundamentals and my technicals. Fundamentals drive price, but with fundamentals, I cannot time the market. And that's why I use technicals to time.
For years, the Forex trading world has been dominated by the narrative that psychology is the key to success. Phrases like trading is 80% psychology have become the new norm, suggesting that even the most sophisticated strategies are doomed without the right mindset. But what if I told you that this narrative is flawed? That the true path to consistent profits lies not in managing your emotions, but in honing your trading skills, month over month and trade after trade. In this video, I'll be diving deeper into why trading skill trumps psychology, and also how focusing on mastering your trading skill will put you in the top 1% of traders in the entire world. I will also talk about the difference between trading psychology and market psychology. I see a lot of beginner traders can't separate the two. And trust me, if you don't know what animal spirits, you'll want to stick around for the second half of this video. First off, let me share my perspective on this. I want you to know where my mindset originated from. Let's say there's a trader standing at a crossroad. It's getting late and he's fairly certain that each one of the two roads will get him to his destination. The first one is a shortcut that goes through the woods. This one might get him there in a couple of hours, however, it looks sketchy to say the least. The second road is a very long one, could take him months, but it's a paved with road signs all over. This is what happens with most beginner traders. They choose the shortcut. Only after a few miles in, they find out the road disappeared. It's nighttime. They are lost in the woods. Can't go forward, can't go back. They are stuck and have to rely on their intuition to get out safely. And when they can't, they blame their gut, or their sense of direction, or their camping skills. In other words, they blame their ability to interpret the dangerous world they put themselves in. Oh, come on. To that I say, you had a safe and well-designed road to profitability. These are the actual trading skills that mattered.
Probably easier when you get to your destination to just do a George Michael.
But nope, you chose not to take it. Alright, but how is the long road any different? Well, for starters, the reason why it's a long road is that it takes time and consistency to build your trading skill set. Otherwise, you have no edge in trading. And I can say with a lot of confidence, there are 3 crucial skills that you can't start your trading career without knowing all about them. Number 1, technical analysis proficiency. You have to understand chart patterns, risk to reward, direction, location, filled order and unfilled order. The one method that puts all of these concepts together is supply and demand. Don't waste your time with price-based indicators like RSI or moving averages. These indicators move only after the price has moved, making them some of the most lagging ways to predict the market turns. I explained all of that in my supply and demand playlist. Go check it out. To put it nicely, every decision you make using these lagging indicators is compromised. And it pushes you one step closer to giving up and believing in the phrase, trading is 80% psychology. No, it's not. Trading is 80% strategy and tools that accurately predict the market. Number 2, understanding fundamental analysis. So, if we can't use price-driven indicators, what indicators can we use? And that brings us to the true depth of trading. The one that most of the retail traders never get to reach. Fundamentals make all the necessary connections between interest rates, gold, dollar index, bonds, seasonal trends, overvaluation of assets, and hidden market orders. Having tools designed specifically to figure all of this out is priceless. Comparing this knowledge to the everyday indicators is like comparing gold to dust. That's exactly how banks and institutions trade, and their win rate and risk to reward ratio is consistently profitable. And guess what? When you reach this stage, and I'm talking from experience here, when you consistently feel more likely to win, you will consistently win. And that helps your trading psychology dramatically. The pressure will be considerably less. The decisions will be rule-based and automated. The losses become everyday business expenditure, and wins grow more and more predictable. You can't compare the psychology associated with that to the psychology of the RSI. Number 3, risk management. Effective risk management is the cornerstone of long-term trading success. When we talk about the need to have stop losses, the need to risk only 1 to 2% per trade, the need to diversify your portfolio, these are not packed advices ready to go in every video. They are the foundations of risk management that I built my trading career on. Risk management is discipline. And discipline helps you avoid significant losses and stay in the game. It will mold you into being a better trader and will shape your psychology. I have to say, as someone who met hundreds of traders from every corner of the world, the more disciplined and profitable a trader is, the more likely he'll agree to the term trading psychology is overrated, especially with how influencers throw it around to gain traction. Now that you've understood the importance of these trading skills, let's talk a bit more on why I think psychology is overrated in trading. While psychology is undeniably important in all aspects of life, when it comes to trading, it has its limits. Traders who focus on controlling their emotions without doing the necessary work to learn trading will never be consistently profitable. And I will give you 3 reasons why. The first reason is cognitive biases are true enemy. Psychological biases are deeply rooted and they are so hard to overcome entirely. Okay, what is a cognitive bias anyway? It is a systematic pattern of deviation from rationality. Like when your trade is running, all of your fundamentals haven't changed. It just dipped below the entry for a little bit. So you freak out and close the trade. And it happens over and over again. Every time for one silly reason after the other. Even the most disciplined traders can fall prey to biases like anchoring or confirmation bias. Anchoring is finding patterns that aren't really there on the chart. It's like you're anchoring your judgment to a flawed pattern or an indicator that has nothing to do with the trade whatsoever. You just believe in it so much because it's the first thing you learn. I see traders make this mistake all the time when trying to detect trend. Maybe I should make a video about that someday. Confirmation bias is thinking a demand zone that was visited 3 times before will hold for the 4th time. Some people like to call that weak trading psychology. Good for them. I call that a non-fresh zone. I disregard it completely and I carried the next zone instead. Automated decisions. That's the difference between putting a mental effort to be in control of your trades all the time and between having a rule-based decision that literally takes a minute or 2 to my time. The second reason is emotions can be managed, not eliminated. Let's agree to this. Emotional reactions are nature part of trading. Even the most experienced traders swear at the charts every now and then. Guilty as charged.
And then, or it's red, you get really nervous, then you say a bad word in front of the house, then you shout there.
And it's all I can do really, because most of the time I lock myself out of the decision. The trade is already locked. Entry, stop loss, take profit. all pre-planned. So hell yeah, I'm allowed to fly off the handle when the trade is hovering at my stop loss. But I'm not allowed to take any rash decisions when I'm in any emotional state. I have to trust my initial judgment and my analysis. Otherwise, no need for analysis, and I should close all trades at break even. The third reason is sunk cost fallacy. The sunk cost fallacy occurs when someone continues investing time, money, or effort into something not because it's the best decision moving forward, but because they've already invested too much into it. The big mistake here is failing to recognize that sunk costs should not influence future decisions, especially in trading. Imagine a trader buying a stock at $50 per share, expecting it to rise. Instead, the price drops to $35, and all fundamentals suggest the stock will continue declining due to poor market conditions. What's the rational decision here? Of course, he should consider selling the stock to minimize further losses and reallocate the remaining capital into better opportunities. If stocks are tanking, you can invest in gold or bonds, or the euro, or even coffee. However, our friend here doesn't know the fundamentals, so he falls into the trap of sunk cost fallacy. He holds onto the stock thinking, I've already lost $15 per share. I can't sell now. I'll wait until it gets back to $50 to break even. This decision is driven by emotional attachment to the initial investment rather than a practical assessment to the market. He ends up losing even more money to the point he sells at a greater loss. Market psychology and animal spirits. Now, everything we've covered so far was about trading psychology, which is a completely different concept from market psychology. Market psychology is often referred to by economists as animal spirits. The term animal spirits is actually based on the Latin phrase spiritus animalis, which means the breath that awakens the human mind. British economist John Keynes coined it back to 1936 to describe this powerful volatile force that feeds the market. But what does it mean really? Animal spirits refer to how the collective human emotions like fear, greed, excitement, or optimism can drive our financial decisions. It's essentially a way to understand the psychology of the market itself. Imagine the market as a separate entity, and it has its own psychology. That's why animal spirits plays a significant role in shaping the herd mentality in investing. And the reason why it's different from trading psychology is that animal spirits is an inclusive term to describe how the entire market moves, or how an asset behaves according to human consensus, meaning most of the market participants are pretty much on the same page, and they are driving the market in a certain direction or causing higher than average volatility. While trading psychology, on the other hand, is what a trader would experience on his own. Call it fighting his own demons. And that does not affect the market whatsoever. That's why I consider it insignificant in the grand scheme of things. Meanwhile, animal spirits can have massive effects on the market, like when trading the news, for example. Remember, we talked about the end of the year rally after the presidential elections. I'm expecting another surge upward and a breakout from this area. Well, on the very same day that Trump won the elections, we saw a massive upward movement in the market. This was not the end of the year rally. This is animal spirits in action, because a couple of weeks before the elections, many investors pulled their money out of the market due to uncertainty. And on election day, at around 9 p.m. Eastern Standard Time, Trump flipped Pennsylvania. And we all know whoever wins Pennsylvania wins the elections. So the market suddenly got confident that Trump has won the race at this point. So all of these investors were buying back, as now the certainty is back. In a nutshell, market psychology is a beast that can sometimes make or break your trades. I personally try to avoid it as much as I can, because its logic is not based on fundamentals, but rather on a grand fear or greed effect, which is not a reliable metric. I understand the logic of those traders who close their open positions before big news events to avoid having to gamble which way the animal spirits might go. Heck, sometimes I'm one of them. But I do not understand those who open or close their trades based on their own fear or greed and later blame it on their weak psychology. This will certainly have detrimental effect on their trading mentality. Finally, I need to say this. Psychology still plays a role in trading. Behavioral finance experts like Dr. Daniel Kahneman have extensively documented the cognitive biases that can derail even the most seasoned traders. Overconfidence, loss aversion, and the illusion of control are just a few of the psychological traps that can lead to poor decision making. However, I fully believe in this quote by trading coach Van K. Taub. Trading is 80% strategy and 20% psychology. The implication is clear. While managing your emotions is important, it's your trading skills that will ultimately determine your long-term success. So what does it take to become a truly skilled trader? It starts with a deep understanding of market dynamics, technical analysis, and risk management. As highlighted in a Vanguard research paper, investors who focus on factors within their control, such as diversification, cost, and tax efficiency, are more likely to achieve their financial goals. The synergy of skill and psychology. Of course, the most successful traders understand that trading is a delicate balance between psychological fortitude and technical expertise. They continuously work on developing both their emotional intelligence and their trading skills, creating a powerful synergy that can lead to consistent, long-term profits. But make no mistake, it is the mastery of trading strategy and technique that forms the foundation of their success. As Dr. Brad Steenbarger, a renowned trader and author, once said, "It's not the trading system that makes the trader, it's the trader that makes the trading system." So the next time you hear someone talking about the primacy of psychology in trading, remember this: true mastery comes from the relentless pursuit of trading skills. It's time to put the myth of trading is 80% psychology to rest. Good luck out there, and I will see you in the next one.